Devang Mehta, who's the Deputy MD and CIO, Equity NDPMS from Spark Private Wealth, joins us to discuss the market fundamentals and his top sectoral picks. Devang, always a pleasure speaking with you. The last time we spoke, you did like, the discretionary names, you did like the capex names, and you did like, some of the auto names along with financials too. Now, as we speak, in financials, if you could tell us what is it that you specifically like? Is it PSU banks? Is it, large private sector banks? Some of the smaller private sector banks which are now seeing a big correction because of one-off issues? Or do you look at NBFCs, gold financiers, and the capital marketplace?
Morning, Mangalam. Always a pleasure to be on CNBC-TV18. Thanks for having me. I think, yes, very clearly what we are seeing across the markets right now, right? 2025, I'll just start off by saying that and come to the financial market question or to the questions on financials. Very importantly, the entire 2025, the last half of 2024 and the start of 2026 has been a stealth bear market. And why I call this a bear market? Because as I always say, index is just a kissing distance away from lifetime highs. But your market breadth, your stocks above 1,000 crore in market cap, around 1,525 stocks, the median fall there is around 25%. So what it presents itself at this point is a plethora of opportunities across the market cap spectrum, be it large caps, be it mid caps, be it small caps, and there has been correction all around. There has been time correction, valuation correction, and also, of course, the severe price correction. Now, coming to the questions on which sectors do we like? Yes, we don't change that very often. We like a combination of financials, we like a combination of capex, capital goods type of companies, and also discretionary consumption amongst financials. Most importantly, Mangalam, the part is that yes, certain PSU banks look interesting. The private banks also, if you just leave out the last one and a half year, I think the last 5 years, if you compare it to the valuations that it used to trade previously, I think these are all at valuations which are lesser, and there is enough margin of safety. But most importantly, rather than margin of safety, there is a capital appreciation which people are thinking for the next 3-5 years. I think yes, with all the volatility around the decisions that are taken for capital marketplace, I still sense that the companies like depositories, exchanges, wealth management companies, even certain brokers, there may be volatility. As I say, yes, probably don't hold me for the next 3 months, but if somebody has horizon for the next 2-3 years, this look very interesting. Why it looks interesting? Typically, yes, the financialization wave, and I can't expand more than this, that around 12 crore unique investors, around 21 crore demat accounts, around 19,400 zip codes, where there are only 32 zip codes which don't invest. I think this typically is expanding big time. And my sense that the concept of savings converting to investments and from physical to financial assets, which everybody has talked about, I know it's a crowded trade, but my sense that these companies have the wherewithal to grow at 18, 20, 25% also, some of them. So my sense that capital marketplace followed by certain PSU banks, and of course then certain NBFCs should be your pecking order.
But Devang, the events that have transpired recently with regards to certain private sector banks, does that result in sort of a benefit to PSU banks, especially considering the fact that while most of the private banks are trading at or near their record high levels and also are slightly expensive on the valuation front, PSU banks have had a fairly strong run up as well at the start of the year, but despite that, they still continue to enjoy that valuation comfort.
I think, Thomas, what has happened to this market, to this sector, is that probably I think they have a very clean balance sheet now. They have lean balance sheets. They probably have now all the wherewithal to lend. I think the last quarter, if I'm right, SBI talked about 14% type of credit growth, which they saw last quarter. And my sense that yes, we already reached that mid double digit type of credit growth with whatever RBI is doing. And I think if the word called private capex that also comes back with what type of earnings and what type of management commentaries we heard about, and also government doing its bit again to spur infrastructure in the budget and talking about railways, defense, roadways, railways, ports, airways. I think all these things, if it transpire, then my sense that yes, there will be a new lending cycle which can start, and PSU banks, along with certain private banks, can also be beneficiary of this. So my sense, yes, the financial aspects would be beneficiaries because of capex, as well as if the rising consumption, both discretionary and non-discretionary, do well, there'll be manufacturing, engineering, all this would spur the credit growth as well. So I think yes, PSU banks tend to benefit. They are at valuations which are cheaper than private. That's always the case. But yes, this time I think probably the numbers also support that.
Devang, apart from financials, do you think overall this overhang of tariffs, we'd gone from 50% to 18% in the markets cheered that. Now over the weekend, we've gone from 10% to 15%. But, this uncertainty remains because, this is only valid for the next 150 days or so. Do you think, markets are going to trade with caution? We're seeing some pain in mid-caps already today. But how do you expect this to play out? Or, will we move forward with the base case scenario of 15% staying in?
I think a very difficult question to answer, as we know that every single evening things change, and on the weekend things change drastically. But of course, if I probably have to take a sort of a guess on this, it's an evolving situation. I think markets are a bit prepared about what's happening right now on the export front. Most of these companies who are into exports, maybe a bit of textiles or leather, and of course IT does not get impacted much by this, but the overall slowdown. My sense that there are so many companies which are more domestic centric, as I talked about discretionary consumption, where aspirational Indian is coming up the curve. That's one sector to play. There is a lot of capex, manufacturing, engineering opportunities, where probably yes, it is more of make in India type of companies, and a lot of new age companies. By new age I don't mean companies who are burning cash, but by new age companies I meaning is companies into engineering, semiconductor, manufacturing, cloud, storage. I think there are a lot of such proxy plays in mid and small caps. But as you rightly said, you need to digest the volatility if you are going to be in these companies. But yes, coming back to the question, I think typically we would be more domestic centric in our approach rather than exports, because there are a lot of uncertainties regarding tariffs, and that comes to hamper the companies whenever you are probably taking exposure over there.
Devang, just a final question before we let you go. What are your thoughts on the IT pack? At what point does it become a value buy? Or will you avoid it at any cost?
Manglam, I think honestly, we have gone generally right on this sector, and in most of the client portfolios, when I talk about, I might have a company which is into ER&D or a little bit of AI, but we have generally avoided this large cap typical IT services space, and we continue to do so. Having said that, yes, of course, the valuations now maybe at around 17, 18, 20 times for most of these companies may look attractive, but whether the 1 to 3% type of constant currency growth that comes, does that sort of justify the valuation at this point? My sense that, as I said, there are so many good domestic centric sectors where you can still compound your money at 15, 18, 20% and even more in certain cases. Then why probably be into companies where you probably have a I think vision of 10, 12% type of growth? Can these companies give you 10, 12% type of CAGR returns over the next 5 years? Very well possible. If they go into digitization, they go into a little bit of AI diversification. But as I said, I'll not probably be bold enough to put money here. I want certain evidence that these companies are showing that path. Otherwise, probably we would avoid.
That's perhaps the path down which, a lot of these consumer staple companies are going to as well. 50, 60 times valuations and growing in, at best, mid-single digits for a lot of the larger players. With that, we'll take a short break. Thank you, Devang, for joining in. We'll get you more on the markets on the other side.